Good afternoon, everyone. My name is Scott Lurie with the Hard Money Co. And today I am joined with Eugene Marshall, who's going to share with us so much information, and I should say free information, on our free webinars specifically focused to the three-letter word that is the nastiest three-letter word in our country, which is taxes. As a real estate professional, understanding the liability of your taxes provides you with an unbelievable opportunity to make more money, keep more money, and save more money. It's an unbelievable opportunity that if you don't pay attention to it, can either cost you a lot of money or tax planning that actually will pay for itself. So we're going to let Eugene introduce himself in a minute, but I just want to go through a couple of the rules today and welcome everyone to our free webinar series. The Hard Money Co. puts on a free webinar series. As I started in real estate in 2003, we didn't have free webinar series. And so I'm so excited today to be able to continue to share knowledge with you. This is free information. We will never sell you anything. I don't have anything to sell you. We're here to provide you with free education, information, and opportunity for you to become better as who you are as a real estate investor. And for us, that is the most rewarding part of this entire process. We've talked briefly about some of our topics. Last month, we went over valuation insights. We had great feedback from that, and we had a tremendous audience for that. Today, tax planning. I was so fortunate to have Eugene join us today. Eugene is a wealth of knowledge. He has a tremendous background in tax, and he is a rock star who focuses on one category in tax, and that's the category all of us care about, which is real estate. What could be better? I'm so excited about that, but I want to share a little bit about where I started. In August of 2003, I started at zero. I was at the bottom, meaning I never even got started. I had zero real estate, zero assets, $0, but all I knew was I had one goal, and that was to become wealthy through real estate, and I had the hustle and desire to become successful. Being successful is not easy. It takes a lot of challenges. You get punched in your face 3 to 4 times a day, but it's about getting back up and doing the best you can for that day to be a success. And so I'm so excited about sharing this information with you today. My path to knowledge is that I decided to pursue everything I had, focus on real estate, and I wanted to create 2 things: generational wealth and real estate assets. And real estate is the only category that in 2003, you could start with zero knowledge or assets, and you could build up to what could be a multi-$100 million facility. And today I'm proud that that's what we have at F Street and the Hard Money Co. So as an introduction, I'm going to look over here and see Eugene Marshall. Eugene, has been a pleasure to talk with up today. Eugene, welcome to our webinar. Thanks so much for being here. Share with the audience a little bit about your background and about Magnolia Tax Services.
Absolutely. So Eugene Marshall, I'm a licensed enrolled agent. I've been buying real estate since 2018. I started out buying 2-unit buildings, 3-unit buildings. I've done fix and flips. I've done wholesale deals. And now as of last year, we started buying and acquiring large multifamily properties, 20-unit buildings, 30-unit buildings, predominantly on the south side of Chicago. Magnolia Tax Services is a tax advisory practice that specializes in tax planning, tax preparation. We do a ton of tax representation and accounting for individuals and small businesses. 90% of our client base are all in the real estate space. I can't tell you guys how many people we talk to all the time, and they say, hey, my CPA doesn't understand real estate. He doesn't understand cost segregation. He doesn't understand how I can buy properties creatively and have a 1098 that is not in my name, but I can still capture the mortgage interest on that piece of property. So Eugene here, I'm very excited to share this information with you guys. Scott and I have been talking about this for quite some time now. We're getting ready to give you guys some free information, okay? Some high quality free information. The one saying that I have is that people who don't pay attention, right? People who don't pay attention. But Scott reassured me that you guys are not like that. You guys have momentum. You have energy, right? And you want to win and you want to win big. And we're going to teach you exactly how to do that today.
Awesome. It's great to have you here, Eugene. And today's webinar is really focused on obviously tax planning and tax sheltering and tax savings. All of what Eugene might have just said related to cost segregation might be new to you, but regardless, it won't be new to you at the end of this webinar. We will be mindful of your time. As you have a question, please put it in the chat. We like to put out a couple business tips, networking goals, set daily and weekly objectives for new contacts. I like to meet new people every single day. I add new people to our network every single day. I hope you're doing the same thing. I'm fortunate to have added Eugene to my network. Eugene's already introduced me to 3 people in his network. My network's growing because of my introduction to Eugene. So make sure you're out there networking and continuing to be a opportunity finder for yourself. So we talk about tax planning. Let's talk about it, right? The ultimate goal is to make as much money as possible and pay as little as tax as possible. It's the ultimate opportunity, and real estate's allowed for it. We want to reduce or eliminate your tax burden, and there are very, very unique and very specific ways as a real estate investor you can achieve that. You can earn $1 million a year and pay no tax.
Absolutely.
That's possible. That actually happens to a lot of people. You can have a negative loss and earn $1 million a year. There is no other business in the world that allows you that opportunity. None. So let's talk about tax planning. Are you planning or are you just reacting? So when we talk about investors and how people operate, most successful people are planning. Most successful people are looking forward to tomorrow, 2024. Myself personally, I meet with our tax consultants 4 times a year. I discuss our tax obligations, what we're looking forward to, what we're acquiring, what we're disposing of, what our disposition burden might be, and how we can plan to avoid liability. I do that 4 times a year. But how many times are you doing that is the question. Are you reacting to, oh my God, it's January 1st or December 29th, and I've got a tax problem that I can't react to, puts you in a position of weakness. Please be a planner. Planning is really important. So when we're talking about planning versus preparation, we obviously look at tax planning versus tax preparation. Before year end is when you're doing the planning, right? Start today. Today is May 14th or 15th. You can start your 2024 tax planning today, right?
Today, absolutely.
And most people can get through that in what, an hour of discussion?
An hour discussion.
Okay, so an hour discussion for a fix and flipper, you can get through your stuff. If you're looking for tax preparation, that's what happens at the end of the year before you file for your March 15th deadline, and then ultimately the April 15th personal deadline for your personal one.
And I want to build on this for a second. What I've realized, what the average person do is they don't start looking for a tax professional until tax filing season.
Yeah, right.
You know, and they're reacting, right? Licensed tax professionals, we're limited to what we can do for you. Okay, the only thing that we're doing if you come to us doing tax filing season is we're recording in the tax return what you did the prior year, right? We're limited. Now, there's a few things that we can do. Yeah, we can still do a cost seg. Yeah, we can still tell you contribute to an HSA or a retirement account. But if we have the ability to be able to plan, Scott is meeting with his guy 4 times a year, right? There's a lot of folks that are not meeting with their person, not even for 15 minutes throughout the year. They don't talk to them to the next tax filing season. And this is why the planning is so important. Because if we can give you visibility and say, hey, Eugene, looks like your tax bill is going to be $50,000 for the year. Here's what we can do between May 15th, May 14th until December 31st. Man, that's huge value.
Yeah, and you have an ability, once you know that your $50,000 tax liability could be zero by following these 3 paths, that gives you that planning opportunity. Talk a little bit about the preparation process, because so everyone is used to the preparation, sure, right? Hey, I need to file this tax return. You probably get a lot of calls from what, March through April 15th saying, help me, help me, help me. Absolutely. What does that look like?
So here's what happens, okay? There's so many people last minute. Hey, I need to file my tax returns. Hey, I need to file my tax returns. First off, let me say this. A lot of folks, there's nothing wrong with filing an extension. The last thing that you want to do is be in such a hurry to get a tax return done that you miss something, okay? Or that your tax professional missed something. So it's important that as you guys are out there fixing and flipping these properties, that you have accurate books, okay? You have the proper income statement, you have the proper balance sheet so that we can properly record everything in the tax return. I can't tell you guys how many times we work with fix and flippers and their books are just not good. It is not a good, accurate representation of how much income they truly made on a deal. Because our goal is to, one, save you money on taxes so that you can reinvest that money back into your business. You can come back to the Hard Money Co and say, hey, I'm ready for the next deal. Okay, you want to make sure that you have a pipeline of deals that is just sitting there ready for you to just take control so you can maximize your growth and accelerate your wealth accumulation. And that's why it's important for you to have your finances and your financial statements on par.
Yeah, so we're going to talk a lot more about this because we're going to talk about bookkeeping and planning, but how many times, what percentage, because I'm going to guess it's very high, what percentage of people when they don't keep accurate books harm themselves, meaning they are paying more taxes because they don't properly record all their expenses or all the opportunity for expenses, and then at the end of the day they're like, well, this is all I have because I didn't keep accurate records? That's
a great question. So here's what we've seen. Okay, if we have a taxpayer that does not have accurate record keeping, they typically pay 77% more.
Wow.
Okay, they pay 77% more in taxes than the taxpayer that's organized. In fact, Not only do they pay 77% more in taxes, but they increase their audit risk so much. Okay, because a lot of taxpayers, they're afraid of the examination, they're afraid of the audit, but you shouldn't be. Okay, you should not be, as long as you have proper record keeping, you have proper tax planning, and we can talk about what you can deduct versus what you can't deduct, rather than just putting a financial statement together last minute because you're trying to get to the next deal.
77%.
That's high.
That would if you're paying, well, if you're paying $100,000, you'd be paying almost $200,000 that is unneeded that you don't need to plan.
Exactly.
So this is a new topic.
Yeah.
Run through this a little bit. So we were talking about beneficial owners. Great topic to discuss because the federal government just made some material changes for all of us.
Absolutely.
Let's hear about it.
Here, so FinCEN, okay, the Financial Crimes Enforcement Network said, hey, look, we're getting screwed. There's a lot of people hiding behind entities in Wyoming, entities in Delaware that are owned by other entities that are owned by trust, and they're committing crimes. And it's hard for them to determine who actually owns this business. And so some of the things that we talk about with our clients is asset protection. Okay, so for many of our clients, we have holding companies in Wyoming, and those holding companies own other entities that own the assets in the state where their property is physically located. And the reason why we create these holding companies in states like Wyoming or in Delaware is because they're COPE entities, charging order of protection entity, and it gives you the anonymity. Now, when FinCEN came out with this beneficial ownership information report, a lot of my clients were like, man, is this going to get rid of my anonymity? No, you will still keep your anonymity because it is not a public-facing database. Your information is only going to FinCEN. And what they say is, they say, hey, if you had an LLC, if you had an entity that was established before January 1st of 2024, you have all year, okay, you have the entire year until January 1st of 2025 to report that you own the business. If you have a new entity that was established January 1st or later, you have 90 days. Now, starting in January 1st of 2025, you're only going to have 30 days. If you do not do this, they say, hey, there's a penalty of $500 per day until you actually file the report. And in fact, that penalty adjusts with inflation. So it's technically $591 per day year to date.
That's crazy. And so this is a new thing for everyone. And we're seeing a huge, we're seeing a very slow upstart to seeing this happen. But if you have an LLC that has 3 members in it, they want to know who the 3 members are. You're going to have to upload them under the beneficial owner. And we're running through this here. We've got hundreds of LLCs and we're seeing it happen. But a $500 penalty is a nasty penalty at the end of the day.
Absolutely.
So understanding, you briefly just went through this, but just to go through it, you basically have 90 days for a new entity. You have a year through the old entity, and any new entities in 2025, you have 30 days to apply. Okay. Failure to report, $500. Criminal penalties. It's simple to report, so let's not make sure we're missing any of this.
And the report only takes 5 minutes.
5 minutes.
It's a 5-minute report. You can have your CPA, you can have your tax provider knock it out. In fact, you can even knock it out yourself, but we got to make sure that we get it done.
All right. So here's the next question that we ask all the time. What can I claim on my taxes? How do I get my deductions? Sure. How can I write off my meal? I took an investor out for dinner, or I took out one of my bankers out for dinner, or I drove to a property.
Yeah.
Let's talk a little bit about, can I claim this on my taxes? And let's go through this at a high level.
This is my favorite part of the presentation because we can talk about the fun stuff, right? What can you do? But before we can write anything off, we have to establish the first fundamental principle of being in business, and that's to create income, right? A lot of people forget that step. So you can't write anything off if you're not creating income. And creating income is a skill, right? How do you identify a lead? How do you convert that lead into a sale? Okay, now how do I fulfill that agreement? Right? In this case, how do I make sure I got my subcontractors lined up and ready to roll so that we can get into that property, get out of that property, get it listed on the market, get it sold so I can come back to the Hard Money Co and get to the next deal, right? What does that system look like? And the first step in that system is creating income. Now, once we create income, now we can focus on what the tax write-offs look like. And Code Section 162A tells us that a tax write-off is anything ordinary and necessary in the pursuit of income. I can't tell you guys how many audits, how many examinations we do yearly, okay? And the one thing that the revenue agent, that the revenue officer asks us, they say, hey, how was this transaction ordinary and necessary in the pursuit of income, meaning I needed to make this purchase in order for me to advance my business. So we're going to talk about home office very briefly, meals, auto, real estate professional tax status, which is my favorite. I mean, real estate professional tax status is a gift from the IRS. I mean, it's the best gift that you can have. We're going to talk about how you can implement this in your business right away. And we're going to talk about travel. Scott and I were just talking about, you know, where we were at over the weekend. He was in Miami. I was in Miami. I had a great time. I got a lot of nice write-offs. And I looked at some properties too. We're going to talk about health insurance and retirement. So let's go ahead and kick this off. Home office. Okay. Everybody should have a dedicated space in their home that they can use to ultimately advance their deals, right? This space in your home, you can talk to your contractors. The space in your home, you can call up Scott. The space in your home, you can use to source deals, right? Get to the next project. COVID taught us that you can work from home, right? You can work from home as long as you have access to the internet. Now, there's two ways we can take a home office deduction, okay? And one thing about us at Magnolia, we have enrolled agents, we have certified public accountants, and we also have just traditional tax preparers that are unlicensed, but they have a ton of experience preparing tax returns. One thing that we do is we always, on a monthly basis, we read IRS publications as they come out, okay? There's two ways that we can take a home office deduction. We can take the simplified method, okay, or we can take the actual area method. With the simplified method, the IRS gives us $5 a square feet, okay, no more than 300 square feet. Okay, that's a $1,500 tax deduction with your name on it, just for having some place in your office, in your house, that you can use regularly and exclusively for business purposes. That's the exact.
Is that a monthly or an annual?
That's an annual.
Okay, so they allow for an annual of $1,500 deduction.
Exactly, and you didn't spend no money. You didn't spend no money. They just gave it to you because you have a space that you use regularly and exclusively for business purposes. Now, for the most part, some of you may be thinking, well, that $1,500 that's not enough for me. You know, I need a little bit more than that. Well, what can you do? You can take the actual area method, and we record the actual area method on Form 8829 if you file as a sole proprietor, and or we can force it into the 1120S if you file as an S corporation. But technically, let's just say that the total square feet of your home or your apartment is 1,000 square feet. Okay, and the area that you use for business purposes is 300 square feet. Well, now you can take 30%. Okay, you can take 30% of all of the costs that's associated with you doing business out of your home or out of your apartment. Okay, and then we can combine that with the Augusta rule, okay, where we can lease your home to your business for 14 days out of the year and give you a $14,000 tax deduction that you don't have to pay any tax on. Okay, but that's a separate topic. But we can combine these two and create a massive home office tax deduction for not just you, but for the business as well. And that's why I love the home office deduction. Everybody should have a home office.
Yes, so just by show of hands or just by someone saying yes or no in the chat, how many people are using their home office and getting a tax deduction? If you're doing it already, write yes. If you're not, put down the thumbs down, and we're gonna get to you. But home office deduction is a core, basic, fundamental. If you're working from home, if you don't have an office and you're working out of your house, take the deduction, pay less tax.
Absolutely. Take the deduction, pay less tax. Do not let your tax professional tell you cannot take a home office deduction. All right, meals. Okay, what happened? Do you guys remember what happened in 2021?
Yeah.
What happened in 2021? Anybody remember? COVID.
Start of it, March.
COVID happened, right? When COVID happened, everybody was stuck at the house. You know, I remember going into Qdoba, I seen somebody with a gas mask on. Like, seriously, like, is it really that serious? So what happened? They shut everything down. And when I think about the tax code is nothing more, nothing less, but a big incentive plan. Hey, Scott, if you do these things, we're going to reward you with tax benefits. And when you actually look at the tax code, that you realize the things that they're telling you to do are actually things that are going to help you build more wealth for yourself, such as provide affordable housing. Okay, you get in exchange depreciation. Now, in 2021, businesses shut down. So they said, hey, to re-stimulate the economy, we need to figure out a way to get our taxpayers, the people that help make this country what it is, our small businesses and our business owners, we got to figure out a way to get them to spend more money. So they said, hey, instead of us having meals being 50% deductible, we're going to make meals 100% tax deductible. and they made it 100% tax deductible so that these small business owners can get out and start spending money. And they did the same thing for 2022. In 2023, they said, hey, no more COVID. We're dropping it back down to 50%. Well, I got news for you. Okay. I have never went out to eat. Me personally, I have never went out to eat and that meal was not tax deductible for me. Because I'm always talking about business. What does the rule say? It says, hey, as long as you talk about business before, during, or after the meal, that meal is 50% tax deductible. They give us 3 times to talk. They give us 3 times to talk about business. I can talk about business when I get there. Okay. Let's just say I forgot. I can talk about business while I'm eating the meal. But let's just say the food is so good and the atmosphere is great and the conversation is amazing. I forget then. Dude, you can talk about business once you're done.
It's amazing.
You telling me that you got a property under contract, okay? It's not actually, you closed on the property. The deal is done, okay? And you out there, you're meeting with a realtor and you say, hey, I got this off-market deal, right? It's ready to go and I want to put it on the market. These are the photos right here. These are the photos. Here's what we did. Here's the backsplash, okay? Here's how we got the financing. Matter of fact, you should meet this guy, Scott, okay? Because he can help these deals get closed, right? And now you create a deduction in the process of you keeping your mission, keeping your vision moving forward so you can exit out of that deal. Okay?
And you said one thing that's pretty amazing, because every meal that I go to, regardless of where I am, I'm talking business. I'm talking
100%.
networking, I'm talking real estate, I'm talking financing. This is an unbelievable deduction. If you're not using it and if you're not networking to support your business, please make that change quickly. This is an easy, simple change. One that is 50% deductible right now in 2023, or was in 2023. And it's certainly something that we use here at the Hard Money Co. and F Street all the time.
Absolutely. Here's the question. So the question is, hey, can I take a home office deduction and also do the Augusta rule? Yes. Yes, you can take the home office deduction and take the Augusta rule. So the Augusta rule is nothing more, nothing less, but you renting, okay, your house to the business. Okay, you're renting the house to the business for 14 days out of the year. Okay, with the home office, this is a place that you use regularly and exclusively for business purposes throughout the year. So you can't take both. Now, if we take both, if we take the Augusta rule and home office, what the strategy here is hey, we'll take simplified method on the home office. Okay,
Which is the 1500.
Which is the 1500.
Okay.
We won't do the actual area method. We'll only take the simplified method, okay, and then we'll combine that with the Augusta rule. Now, for many people, they may say, hey, well, I'm an S corp. Okay, how am I going to do the Augusta rule with an S corp? You can still take not the Augusta rule, the home office. You can still take the home office deduction if you're an S corp. And the way that we do that is through employee home office reimbursement. Okay, that's how we label it on the tax return. Employee home office reimbursement. Great question. Okay, keeping this moving along. So let's talk about the vehicle. Okay, last year the mileage rate was 65.5 cents per mile. This year is 67 cents per mile. Okay, so you can either take the mileage deduction or you can take the actual deduction. Now, some of my clients, they get confused. They say, hey, I don't know if I should take mileage this year. I don't know if I should take actual. Well, it depends. Okay, are you someone that drives a lot? If you are someone that drives a lot, what kind of car are you driving? Are you driving a luxury car? Or are you just driving your standard, average, regular daily use vehicle? So it depends. If we have a client that doesn't necessarily drive as much and they drive a nicer car, then we're going to say, hey, let's take actual. Okay, now when we take actual, now we can actually write off the vehicle. Last year, bonus depreciation was at 80%. Okay, it was at 80% last year, and it's phasing out 20% every single year. Okay, and is expected to be completely phased out by 2027. Okay, and so what bonus depreciation does is, so let's say if I buy a vehicle for $100,000, okay, I can put some money down, or I can choose not to put any money down. Okay, in 2024, you can take 60% of that in year one. That's a $60,000 tax deduction with your name on it in year one. Now, it sounds good. Oh, I can buy this vehicle and I can write this vehicle off. But don't forget rule number one in this whole system, and that's to create income. okay? Because we have to create income first so that these deductions make sense. But I'm a big fan of deductions that gives us the opportunity to fund your future. So before we start talking about writing off vehicles, let's start talking about retirement. Let's start talking about asset accumulation through real estate investing first, and then we leave the toys at the end, because what are they? They're just toys, okay? But good one.
Question for you. When you do the actual expenses and you go for bonus depreciation, if I buy a car for
Yep.
$100,000 but finance 100% of it,
Yep.
I still can get the $60,000 deduction even though I put no money into it?
Absolutely.
What a winner.
Absolutely.
What a great code.
You ain't got to put no money down.
So
In
no money
fact-
down, $60,000 loss, and you pay $2,000 a month. Sounds like a winner.
That's the winner. In
Okay.
fact, a lot of people get this confused. They say, well, I didn't write my car off, Eugene, because I didn't buy the vehicle in my business name. You do not have to buy the vehicle in your business name. Nowhere in the tax code does it says that the vehicle must be in the business name. Here's what it says, okay? What it specifically states is that you have to use that vehicle more than 50% of the time for business purposes, okay? All they care about is the usage, not who's on title.
Great one. That's awesome.
All right, real estate professional tax status. So what is real estate professional tax status? How do I qualify? Do I need to be a realtor? Do I need to be a loan originator? Do I need to be an appraiser? No, okay? Anybody can become a real estate professional, okay? Anybody can attain this tax status. And I'm a real estate professional. I own a tax and accounting practice, but I continuously buy real estate every single year. In fact, I have to buy real estate every single year because the moment that I stop buying real estate every single year, that's when I get hit. That's when Uncle Sam started knocking at my door, but I understand the big incentive plan. I understand what to do in order to keep this machine going. And the first step is to create income. And the second step is for me to capture deductions that can fund my future. And the number one deduction that I love is real estate. So what's real estate professional tax status? So let me give you guys just a quick overview. So every United States taxpayer has a $25,000 special allowance that they can take from their rentals. Okay, they can take a loss of $25,000 to offset their taxable income. Now, once your income goes above $150,000, your CPA may say, unfortunately, Eugene, but you're not able to take those losses anymore. And they put those losses in a bucket. Okay, and you're not able to take those losses until you sell that property, right? But if we can qualify you to be taxed as a real estate professional, then you're not subject to that $150,000 income limit, or you're not subject to that $25,000 special allowance. You can take an unlimited amount of deductions. This is how the Donald Trumps of the world, these are how these folks are not paying any taxes because they're leveraging their real estate. Okay, even Joe Biden himself. Okay, even Joe Biden himself, who wants to take capital gains tax rate to 44%, is leveraging his real estate. Okay, so how do we qualify for real estate professional tax status? Well, all we have to do is meet some tests. That's it. They say, hey, Eugene, if you meet these tests, we can qualify you. So what are those tests? Okay, here's the test. If you materially participate, okay, in your rental activity for more than 750 hours or more in a year, okay, and more than 50% of your time and more than anyone else, you qualify.
Because this is an important one, because a lot of people ask this question, do I
Yeah.
qualify? And we've got a lot of wholesalers, we've got flippers, we've got burst strategies, we got buy and holds, we got renters, landlords, we got short-term rentals, people on the deal, which short-term rentals has a loophole we'll discuss, and you'll discuss in a minute, but count 750 hours. Does that include if I'm out bird dogging properties or online searching for properties or driving by properties or touring neighborhoods or touring properties? Is that included in that 750?
Great question. No, it is not. Okay, so a lot of people think that commuting back and forth, to the property is time that you can allocate towards your rental, your material participation. Okay, we actually had a client who, unfortunately, they got their cost seg disallowed because they were counting in those hours. Okay, so I'm telling you from experience, from us talking back and forth to the revenue officer. So what counts? Okay, so it's 750 hours. Okay, materially participating, meaning that you're physically at the property. Okay, you're physically at the property. You're meeting with a contractor. You're picking up rent from your tenants. You may be decorating your Airbnb, your short-term rental. Okay, you're having meetings there. You're physically at the property, materially participating in the operation. Okay, you're screening tenants, right? And you have to spend more than 50% of your time, meaning that if you have a property management company, typically that's when things get a little dicey.
Sure.
Because if you have a property management company, how are you spending more than 50% of your time and more than anyone else in that deal? Okay, so we got to be real careful with tracking our hours and making sure that we're hitting things that actually helps. Now, what I recommend to track your hours is Reps Tracker. Okay, Reps Tracker. I always tell my clients all the time, anything that we deduct, we need to have support and documentation to be able to back it up. Reps Tracker, you can download the app on your phone, and every time you go to the property, you can literally track and log your time. Oh, I went to 751 South Greenwood Avenue today, and I did XYZ. And you can even take a photo while you're there. Okay, so we have substantial proof in the event where a revenue officer or you get a letter, we're ready to roll, we're locked in.
Reps Tracker is available, I'm sure, on the Apple Store.
Yeah.
Yeah, great.
Yeah. Now, for a lot of folks, they're like, hey, man, how am I going to do this? Okay, how am I going to hit the 750 hours where there's always, if there's the will, there's a way. And I love the IRS because there's always somebody there that says, hey, look, we need to figure this out. We need to come up with a way to make this happen. So what do? They said, hey, there's this new thing called Airbnb, okay, VRBO, booking.com, where people are coming in and they're traveling and they're staying for an average of 7 days or less. All we got to do is meet the 100-hour material participation test now. So would I rather do 750 or would I rather do 100 hours? It's clear as day. We can do the 100 hours, okay? And with real estate professional tax status, you only need to qualify for the tax year that you're taking the deduction. Okay, so we've had clients that will do a short-term rental so that we can do the cost tag, we log their hours, and then maybe for the next year, they don't have the Airbnb no more. They turn it into a long-term rental. Okay, so we have different scenarios where we can talk about what makes sense for you. But one thing I want to stress upon before we move past this slide is we never buy real estate solely for a tax deduction. I have some clients that have significant income where they're just like, look, I just need to buy something for the write-off, right? We're not buying anything just for the write-off because remember, as you guys know, especially if you're working with the Hard Money Code, that when you go out there and you're buying what the numbers say on paper. That's it. That's all we're buying. So many people get caught up in the amount of bedrooms and the amount of bathrooms. No, you're buying what the numbers say. That's it. And if the numbers make sense, we do the deal. If the numbers don't make sense, we don't do the deal. Hell, you run from the deal, right? So real estate professional tax status.
Love it. Got it.
Okay, let's break those questions out in two pieces. What's the first one again? Absolutely.
Repeat the question just so that I'm sorry.
So the question was, can I do another cost seg next year, okay, on another short-term rental and leverage that to offset my W-2 income? Yes, 100%. And Pramod, thanks for coming on board. Pramod is a tax planning client of ours, and he implemented what we're talking about right now. Okay, he implemented what we're talking about right now. Okay, Pramod had a short-term rental. Okay, we did a cost seg, and now he's reaping the benefits. In fact, he's actually buying a property for his son right now. Okay, what was the second part? If I convert a long-term to a short-term, will that be counted? Yes. Okay, remember, all we have to do is make sure that we're logging and we're tracking the hours. Okay, we're logging and we're tracking the hours. So if you convert a long-term to a short-term and we log that we tracked our hours, baby, you meet. Let's cost save that thing and let's put some more money back in your pocket. Fire your CPA.
Repeat the question for Richard.
Okay, so
Is it Richard? Okay, repeat Richard's
what
question.
Richard's question is, he's like, hey, look, I'm working with my CPA. My CPA is telling me that, hey, I don't qualify for real estate professional tax status. If I do qualify for real estate professional tax status, I have to make the same amount of income in my real estate that I'm making at my full-time job. That's not true. Okay, nowhere in the Internal Revenue Manual, okay, nowhere in the Internal Revenue Code does it mention anything about income. Okay, what it specifically states is time. Okay, what it specifically states in time. If they were concerned about income, it would be hard for them to hit real estate professional tax status if you have a high W-2 and you're making $500,000 a year. I mean, it's possible, but it takes a lot of time and it takes a lot of commitment and it takes the right deal. More importantly, it takes the right people that you need to be connected with that can show you how to generate $500,000 or more in a year from one particular deal or a series of deals. So for the average person, they would never be able to do that if they was following that logic. So if I were you, I would fire your CPA and I would say, hey, what I want to focus on the most is tracking my hours. Okay, it's all about the hours.
And for a high net worth earner, high W-2 earner, you're talking about hundreds of thousands of dollars of tax. You're
Absolutely.
not talking about a negligible dollars that if I was in your scenario, Richard, or anybody else out there, I would be making a compelling argument. The test is 750 hours, 100 on the short-term rental threshold. Depending on what your portfolio looks like, you certainly should be able to find the time. 40 hours a week is way too much of what you need to produce to get to the 750. And you do have the ability to work more than 8 hours in a day, and you have the ability to do multiple things. So this is a huge opportunity for you and everyone else out there. And I would push the envelope here because I think you have a very compelling reason to save yourself hundreds of thousands of dollars.
All right, moving right along.
Yes.
We got to get to
Yes.
Sounds good. Absolutely. Let's have a conversation. You know, let's talk about your facts and circumstances first. And then if the shoe fits, we'll wear it together. Okay. If the shoe fits, we will wear it together. More importantly, my focus is on you creating income. Okay. I want to help you scale. I want to help you grow your business. Because if I can help you scale and I can help you grow your business, then we can start having conversations around where we can park the money. Okay. Not hide the money. I said park the money because if I say hide the money, it sounds like I'm trying to do something else. But where can we park the money? And trust me, I will find a way for us to park the money, and we can put it in oil and gas. We can put it back into real estate. There's plenty of opportunities out there. But I want to talk about business travel. Okay, why is business travel so important? Business travel is incredibly important. I mean, I travel a lot. You know, I literally travel so much. Okay, I was in Miami over the weekend. Friday, I'm going to Portugal. I come back from Portugal for 1 day. I'm going to Dallas. I flee from Dallas. I go to Utah. Then I come back to Dallas. Okay. Here is why I love business travel. So first things first, if you guys have an LLC that's disregarded, you want to have or establish a board of advisors. Okay. You want to establish a board of advisors. If you're an S Corp, you should have a board of directors. Okay. And the reason why this board is so important is because this board gives you the opportunity to unlock a lot of tax deductions. Okay, so I have my significant other as a board member of Magnolia. Okay, now a board member does not mean that she's in the business, right? She's not an employee of the business. She has no ownership of the business, but she's a board member. She's somebody that I go to where I can talk about business and she gives me advice. She consults me and the company on how we can grow, on how we can scale. So guess what? When I travel with my significant other is a board member. I can now write her expenses off as well. So how do we do this? We simply just have a board meeting. That's it. We have a board meeting. In that board meeting, we record meeting minutes, and then we appoint Carly as a board member, and then Carly accepts her position in that board meeting, and we sign and we date it, done, and we put it in the records. So she's now a board member in my business. So when we travel and we go have a board meeting in Miami and we go talk about business, ways for us to get into new markets, ways for us to capture more leads, ways for us to do the first step in the system, which is create income. Now I unlock a ton of tax deductions. Now, what do they say? They say, hey, you can travel, okay? But what is the specific use case of that travel? Okay. Well, if I go have a board meeting, all I have to do is work 4 hours a day on a working day. 4 hours a day on a working day. So if I travel to Miami on a Thursday, everything en route to Miami is tax deductible. Okay. When I get there on Friday, I just work 4 hours and I have a board meeting. I take meeting minutes. Okay. And I send some emails and I have a Google Calendar to support what I'm doing. And I jot down what time we started, what time we ended, and who was all there. Friday, Saturday, Sunday, I don't have to do anything. It's not a working day. It's the weekend. So on Saturday and Sunday, when we go to 11, when we go to live, right, or when we go to certain places, now we're having we're building team camaraderie, okay? Because we're out there and we're learning more about each other and we're building a team. And on Monday, I work another 4 hours and I fly out on Tuesday. My whole weekend was tax deductible. So I love business travel. I always recommend that you guys should travel at least once a quarter. Okay. You should travel at least once a quarter. And the reason why a lot of business owners have big or major or significant or huge, massive tax bills is because they hold on to the money too much. Okay. They hold on to the money. Get rid of the money. Right? If you get rid of the money and you enjoy some of it, now we can start figuring out how we can help you create a tax-free lifestyle in the process. Health insurance. So you can deduct your health insurance as well. Did you want to add anything to that?
No, we'll talk about that in a minute. No, keep going.
You can deduct your health insurance as well. So if you're an S Corp owner, you can deduct your health insurance if the company is paying for the premiums. Okay, you do not have to have a company policy. Okay, the policy could be in your name, but the company still has to make those premiums every single month. And what happens is your payroll provider will include the income, will include it as income in your W-2 wages. So if your health insurance is $100 a month, that's $1,200 a year, and you pay yourself 60 grand a year, W-2, well, what happens is box one is going to say 61,200, okay, because they're going to add what you wrote off for health insurance as income. That's how you write it off, because you write it off through the wages, okay, for the business. Now, it's important that we understand how many employees are in the business as well, because that's when things get a bit interesting. Okay, so if you're a solo business owner, you're the only employee, we can have conversations about this all day, right? And then all we do is we just make the adjustment on your personal tax return, and now you pay no tax, okay, on that additional box one wages. All right. Retirement savings. So I talked about having deductions that can fund your future, okay? Now, what did I say earlier? I love real estate. I got a lot of clients who are just like anti-stock market. They don't want to touch it, but it's important that you diversify. But even if you don't want to be in the stock market, you don't want to lock the money up, you want control of the money, well, we can use and leverage a self-directed IRA. And we'll talk about that. And I'm pretty sure Scott may want to weigh in on that, because you guys are working with a lot of folks that are doing self-directed IRAs all the time.
Yeah, it's self-directed IRAs are one of the largest investment components that invest in our lending business as well as into all of our syndication funds. So having the ability to create a self-directed IRA where you control your destiny. I don't want to be in a mutual fund. I want to be in multifamily, industrial. You can, there's hundreds of categories that you can jump into as self-directed. And it is the biggest opportunity that once Wall Street gets shaken off of the mutual funds and the IRAs that they control, the world is getting wealthier and better. And this is a huge opportunity that I strongly encourage everyone to participate in.
Absolutely. All right.
We talked briefly about a business that be accessible. You know, there's so many people I talk to every single day that can't get on the phone with me or can't respond. Communication's key. I'm accessible. If you call, I'm answering. I bet if you call Eugene, he's answering. I encourage you to be accessible. And we just want to throw that out there as a great business tip for today. So then we ask, how else can I maximize my savings? Let's run through this a little bit, Eugene. I think this is some really good information.
Absolutely. So we talked about real estate professional tax status, okay? But we didn't talk about why is it important, Okay, sure, I get this 20. I don't have these income limits of 150 anymore. I'm not stuck in this bucket of a $25,000 special allowance, so I gotta wait till I sell. Well, if you qualify for real estate professional tax status, now we can do something known as accelerated depreciation.
How many,
Okay.
by show of hands in the chat, how many people have heard of cost segregation or have done a cost segregation? Just put in a thumbs up or a yes. We're getting a bunch. How many people have never heard of this concept before? Type in a no or a thumbs down. Because this, to me, Eugene, is one of the greatest opportunities in real estate for real estate investors ever created under the code. You want to talk about how the billionaires become multiple billionaires and how the wealthy get wealthier? It is solely driven off of, in my opinion, the minimization of tax and cost segregation. And cost segregation on a single family home short-term rental or on a 20 unit or on a skyscraper in Manhattan has an unbelievable power here. And run through this because this is so critical. We do this on every single deal we acquire, build, create. When you build, it's a 179D. It's a little different process, but let's talk cost segregation study just from the core basics.
Oh my God, I love cost seg. Okay, so when you buy real estate, okay, the IRS gives you the big D, okay, which is known as depreciation. And depreciation in the tax space, we call it a phantom expense. Okay, it's a made up expense. The expense does not exist. You did not spend that money, okay, to do it. But they say, hey, taxpayer, thank you. Thank you for providing affordable housing. In return, I'm going to gift this to you. It's the biggest gift that the IRS, the federal government gave us, but not many people are taking advantage of it. And they're not taking advantage of it because they either don't know how to, okay, or they simply don't care to, okay? And if you don't care to, then it's just foolish and it's ignorant because one thing that's for sure, or two things that's for sure, is death and taxes. Okay, two things that's for sure is death and taxes. So generally speaking, okay, on paper, in most scenarios, real estate typically comes at a loss. On paper, okay, I did not say an operational loss. If you're having an operational loss, you need to exit. You need to get out of that deal right away. Okay, but generally speaking, real estate generates a paper loss. So you're generating all this cash flow, right, throughout the year, and then the big D kicks in and it wipes out all that cash flow. So you paid no tax on that rental income that you were receiving all year long. Okay, and that's what we determine, or that's what we call what is known as a paper loss. Okay, operational positive, paper loss negative. So with a cost segregation study, basically what happens is an engineering company comes out and they're looking for everything on that piece of property that has a useful life of 15 years or less. They're looking at the roof, they're looking at furnaces, they're looking at appliances, they're looking at the cabinets, they're looking at the PVC, they're looking at the electrical, and they're accelerating the depreciation on that. Okay, and they're giving you a big deduction in year one. Okay?
What is the what is the, if you don't do a cost seg, you're getting a deduction of what, 27 and a half years, 20, what's the baseline of your deduction? Just buying real estate, you get that phantom, what's that number?
Yeah, so the number is this. So if it's residential, okay, you're going to take that depreciation straight line over 27 and a half years. Okay, if it's commercial, you're going to take it over 39 years. Now, a lot of folks don't know this, and here's where we see a lot of issues. Okay, we see a lot of issues with this. If a taxpayer did a cost seg with another accountant or another tax provider, and they did a cost seg on a short-term rental, okay, now that short-term rental may be a single-family home, which is residential. Right, that's residential. Okay, but if you're doing a short-term rental, now again, what it says in the code is that the average stay must be 7 days or less. Okay, 7 days or less. So what happens is with the short-term rental, it doesn't follow that 27 and a half no more. Okay, it follows the commercial, okay, of 39 years. Right, and so we see short-term rentals being depreciated on a cost seg at 27 and a half. And that's the biggest way for you to get audited because it's not 27 and a half anymore. It's 39. Now, the cost seg is the best gift. Okay. Now, hell, look, if the best birthday gift is a cost seg study, right? In fact, right off my birthday every single year. right?
Yeah.
How do I do it? I write off my birthday every single year because I don't have a birthday party. I have a networking event. On my birthday every single year, I invite all my friends, all my business partners, and we talk business for 4 hours long with good music, right? So how do we do these things in a way where things can be efficient? Okay. Now, what's the downside?
Peter, did you have a question?
I would not.
Hold on. So the question is, can you do a cost seg on a fix and flip? Eugene, can you do one? The answer is no, but go through it.
Yeah, so I would not do a cost seg on a fix and flip, okay? Because you're going to be exiting that deal, right? Now, if you're going to do a cost seg, we generally recommend that you keep this property and you hold on to this property because there's a thing known as depreciation recapture, okay? It's known as depreciation recapture, where all that depreciation that you took is going to be considered taxable to you, typically at 25%. Okay. Now, if we do a cost seg and you do got to exit, we recommend that we do a 1031. Okay. We recommend that you do a 1031 so that we can roll all that tax that you would have suffered, that you would have experienced over into the next deal. Okay?
And we'll talk briefly about a 1031 in another time. We're going to get into that slide, but it's important that we just jump back to that one slide right before this. Just to understand, a cost segregation, which Eugene said is a third party that you're going to hire.
Yep.
You can hire them. Your accountant can recommend it. They're going to go and do a engineering study to do what creates from the 27.5-year depreciation schedule. It's going to accelerate that to 5 years for carpet. They're going to pull down every piece of nook and cranny out of the property to accelerate it from what Eugene has mentioned, 15 years and under, right? And so the goal is that, and when we buy properties, we can buy a $10 million property and get a $3 million first year loss. And so I can give that gift of loss carry forward to my income, that if you do that every year, you have the ability to offset 44% of ordinary income. And when you do sell it, if you did have to do it, you do recapture at 25%, correct? But it's better than 44% at the end of the day.
Absolutely.
So even at the end of the scenario, either direction, cost segregations are so important. Pay attention. So long as you have income, you have a huge opportunity right here with cost seg, and we can dive more into it. It's not as complicated or scary. The word segregation is just long, but it just means accelerated depreciation of your asset at the end of the day. And it saves people so much money. The high net worth people that are making $10 million a year developing real estate, they're paying zero tax. I guarantee you it's only because of cost segregation studies.
Absolutely. And here's a client of ours that we did not practice. I mean, they got a $90,000 tax refund. They got a $90,000 tax refund. Okay. And they got $90,000 from the feds, okay, from the IRS, and they got $16,000 from the Wisconsin Department of Revenue. Okay. All because they implemented the things that we're telling them to do. Okay. They're a tax planning client. Okay, we meet once a quarter. In fact, this client, we meet once a month because he wants to do it again, because he anticipates that his income is not going to do nothing more but increase, which is a great thing, because the number one rule in business is to create income, right? So we got a lot of clients that are implementing the things that we're talking about. And we briefly talked about the self-directed IRA. I know we got a short period of time.
Yeah, we've got 5 minutes left, so we'll probably carry over with a little Q&A here. As you're starting to think about your Q&A, please drop it in the chat. We'll get through as many questions as you can. Eugene is a wealth of knowledge. You will be able to connect with Eugene afterwards. All of our contact information will be present. But let's just finish through the self-directed IRA one more time, pretty quickly though.
Absolutely. So here's the thing, right? So a lot of people don't realize, or if the average CPA, the average, enrolled agent that's not in the business, they're not actively in the real estate business, they're going to tell you, or your financial, especially your financial advisor, they're going to tell you that you can only invest in these mutual funds, these CDs, the S&P 500, VGT, VTI, all this stuff, right, that you can't control. I like assets that I can control. I can go there. I can touch it. Okay. I know who I'm putting in there. I know the tenant that's coming in there. Okay. I know the property manager that's screening the tenant. I control it. I like controlling. If you want to win big and if you want to scale and grow your business, that you understand that control is necessary, right? Control is necessary. And with a self-directed IRA, what happens is now you can leverage your retirement account to go out there and buy real estate. Okay, your retirement account can do fix and flips. Your retirement account can lend money to other people. Your retirement account can buy rental properties. Okay, but your financial advisor doesn't want you to know that because he or she wants to continue making 1 or 1.25% of all of your assets they have under management. They don't want you to go do this where you're going to maximize your returns. And it's relatively simple. Okay, if we have a retirement account that's just sitting there, okay, or it's not with a current employer and it's earning, but it's not with a current employer, all we do is a trustee to trustee transfer. Okay, we open up the self-directed account. Okay, we fund it via the trustee to trustee transfer. And then we say, hey, custodian, I want to open up an IRA business. I want to open up an LLC. Okay, we fund the business. That business gives us checkbook control, and now we can operate out of that account. Boom. Okay.
Yeah, and checkbook IRAs are also self-directed IRAs, all of those technical nuances. If you have an IRA, shake yourself in the head and say, I want to learn more today about self-directed IRA. Call Eugene. He will walk you through it. One of his tax planners will walk you through it. He'll talk you through it. I can walk you through it. Online can walk you through it, but it's so critical and so important to your IRA. We've got 3 minutes left. Is your entity structured properly? Eugene, let's run through this a little quickly. This is important. We're talking about S corps. We're talking about LLCs. We're talking about C corps. There's so much going on here. Sole proprietor. Let's hear it high level as fast as we can for 3 minutes, and then we're going to get into Q&A.
Boom, high level, right? So here's the deal. If you have an active business, right? If you're wholesaling, you're signing contracts, or if you're doing double escrow closings, right? Or if you're doing fix and flipping, that's an active business. Right? The rental real estate, that's passive. Okay. Though passive income and active income are taxed completely separate. Okay. Here's what we're seeing a lot of times, right? We're seeing a lot of fix and flippers. They're good at creating income. They're good at getting the leads. They're good at getting their subs in there, right? Managing the subs and exiting, but unfortunately, they're not structured correctly. And they're filing on a Schedule C. Okay. They're filing on a Schedule C. And what that Schedule C does, it basically reflects the income and the expenditures that came out of the business, and it's comprised with your personal tax return. Okay. Now, with a Schedule C, you pay 15.3% on your entire net profit. Okay, on your entire net profit. Okay, but when we convert you over to the S corp, now you control how much you pay of that 15.3%, and the 15.3% is nothing more, nothing less, but self-employment tax. Okay, so generally speaking, what we see when individuals or when business owners convert their business to be taxed as an S corporation, they pay 21% less in taxes than Schedule C filers. Okay, they pay 21% less in taxes than Schedule C filers, and they're less audited. Okay,
How much does it cost? Before we get into Q&A, how much does it cost for someone to call you, Eugene, and say, here's my problem. I'm a wholesaler. I'm looking to figure out my structure and I want to get filed right. What is, because people say it's scary. I don't know but paying 21% more is more scary in my opinion. How much does that cost?
Yeah, so first thing that we do is we have a discovery call, okay? And we want to understand your facts and circumstances first. Once we truly understand your facts and circumstances, we do all the legwork for you up front. Okay, and we tell you, we say, hey, Eugene, here's how much we can save you based on your prior year tax return, based on what you expect for your business to generate this year. And we put a plan in place, okay, and we make you a guarantee. Hey, we're guaranteeing that if you follow our direction for the next 12 months, that we will save you X amount of dollars. So everybody's facts and circumstances may be different because we may have one person that may have 2 rental properties. We may have somebody else that have 50 rental properties. And so that price point may be a bit different.
Fair enough. I guess the bigger question is the bang for the buck is there, and they should absolutely be reaching out to you.
100%.
Okay, let's get into, we didn't get into bookkeeping. I'm going to punt this one, Peter, just to the next session because I think it's great. I'd like to go to Q&A because I do want to be mindful of everyone's time. Are there any questions out there from the audience today that would like Eugene to answer them? Here's a schedule to call. Eugene, snap that shot. It'll be a QR code. You'll get right to Magnolia Tax Services, magnoliataxservices.com. What are some questions? So the question is, I think the question is if I were to have a board of directors, am I able to set up the board of directors and do virtual board meetings with them versus an in-person board meeting and then deduct my business travel off of that is basically the question.
Yes.
I want to fly to Miami. I want to
Yes.
then create my board, my Zoom call with my people. Am I able to do that
Yes,
so
we
long
can
as
do
I'm
it.
meeting the 4-hour threshold?
Yes, we can do it. Now we would structure this a little bit different. Short answer is yes, that you can do it, but we would have to structure it just a tad bit different.
Okay. The question is, this individual has lent money to somebody. They've received a 1099 INT for that income.
Yep.
The person also is a real estate investor that executes on the BRRRR strategy.
Okay.
The question becomes, can they use the cost segregation on the BRRRR properties to offset the 1099 INT income that they are receiving?
Yes.
Simple question. Yes.
Yes.
Of course you can. The answer is you're going to take that BRRRR strategy. It's going to be your long-term rental. You're going to cost seg it out. You're going to get an immediate deduction, which is going to immediately impact that 1099 INT you're getting. The only thing that I will ask you is that if you did lend the money from a self-directed IRA, the answer is going to be you're limited on the cost seg. You're not able to get that deduction to your IRA. So then the answer would be no. But the answer is yes. And let's talk about it. So great question. The question is, I'm a local real estate investor in market X. I own properties in market Y. How do I get reps hours because of management in those markets? It's how do I navigate that water so I can get credited for that 750 hours I'm looking for?
Yeah, you gotta visit the property. You gotta be at the property.
So you don't create a Superman approach. You can't just go there. You can't dream about it. You actually have to be physically doing things, and there is a huge audit risk if you're marking this button, this 750, and you're actually not performing it. But I can assure you, 750 hours if you work the 750 hours as a rep status, I can assure you, which is the greatest thing I heard Eugene say all day, is it will help you increase your income.
Absolutely.
It will help you increase your income. So the great question. The question relates to universal life insurance. And so the question is, how do I use a universal life insurance policy to buy real estate, and what are the implications to my taxes?
I don't know who you are, but that's a great question. So if I don't know if it's a VUL, if it's a variable universal life insurance policy, or if it's an index universal life insurance policy, I don't know which one it is, but let's just say it doesn't matter, right? You have a life insurance policy that has accumulated a significant amount of cash value, and you want to leverage that cash value. You want to go out there and buy a piece of real estate. You can do it all day as long as we borrow. Okay, we're borrowing from the policy. We're not taking a withdrawal from the policy, because if we take a withdrawal from the policy, then we're creating a taxable event. But as long as we borrow, because nowhere in the United States of America is a loan taxable, then we have a tax-free event, and you can use that income to go out there and buy more real estate.
Powerful. Nowhere in the tax code is borrowing money a taxable event. Remember that. A refinance is not a taxable event. All right, we had an unbelievable session today, free webinar. As I told you, we're here to share great advice, great knowledge. We have nothing else to share with you other than if you have any other questions, please feel free to put them in the chat. My team here at the Hard Money Co., as well as Eugene's team, Magnolia Tax Services, are going to make this available for you post-show. If you have any friends that weren't able to join us, friends, family, colleagues, or someone you thought might have had a value of this, feel free to do so. Eugene's schedule a call. QR code is on the screen right now. We'll stick around for, how we doing? Okay.
Real quick.
Yep.
Scott, so I got some people on the webinar that may not know what the Hard Money Code does. Can you just share more about what the Hard Money Code does?
Yeah, good one. Yes, thank you. It's on one of our slides, but anyways, we didn't get through all of them today. The Hard Money Co. is a is an industry leader in providing acquisition and renovation capital for real estate investors. We close about 500 loans a year. We focus on the real estate investor that is determined to be successful. We provide acquisition capital. We fund up to 100% of repairs, and we can close in as fast as 10 days. We're closing on a loan today in Bell Harbor, Florida, that I got on Friday for $3.5 million. 4-day close. We're closing on it today, and we can move quick. We've got an unbelievable team here in Milwaukee. We are a very efficient underwriting as well as a risk profile to write your loan and get the deal done. We provide that short-term capital, and we can move quick. If you have any if you want any if you want any other information about us, it's thehardmoneyco.com, or you can reach out to Eugene and he'll share our link, and we'll do the same. We're going to be sharing Eugene's information with our borrowers. We believe that being efficient with tax is so important, and I have determined, based on 20 years of experience, that the number one way for me to continue to create generational cash flow wealth is to avoid paying tax. As long as you follow the code, you can avoid paying tax, and we do that here today. Do we have any other questions at this point? All right. I want to be mindful of everyone's time. We run a little bit past, but I want to thank everybody for joining us today. I also want to thank our special guest today, Eugene Marshall, who's joined us from Magnolia Tax Services. This energy in this room is unbelievable. I'm compelled to go out and share with every one of you all of the reasons why Eugene can be a great asset to you. If it's not Eugene, it's another tax preparer, but make sure you're working with the right, smartest, and best bunch in the group. You're going to pay the same thing. You're going to pay the same amount of money. Why not work with the best? So on behalf of the Hard Money Co., on behalf of my team at F Street, and on behalf of Magnolia Tax Services, I want to thank everyone for being here. And I really want to thank you, Eugene.
Yeah, man.
It was a pleasure to be with you, man. It's great to be with you. Thank you so much.